It's time for the Your Personal Bank Show with Ferenc. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Again, it's yourpersonalbank.com. I really want to thank the people that attended the Master Your Money event we did last week with John Burley. It was a fantastic event. A lot of great information was shared, and I got a significant amount of very positive response from it. I shared the personal bank concept, obviously, some current economic information that I'll be sharing in this show today. I think you'll find extremely valuable. How either your personal bank or fixed assets such as annuities or guaranteed lifetime income could fit into your portfolio. Because again, this is the golden era of fixed assets. We'll discuss that further in today's show. But again, thank you for coming. It was an awesome event. I don't speak very often because the radio show keeps me busy working with clients. So it was an honor to be asked by John Burley to join him and co-presenting a workshop about money, real estate, the economy, all of that kind of stuff. If you have questions or want more information about it, contact me at yourpersonalbank.com. The event was recorded. I will be able to send you the event if you would like to watch it or any of the particulars that were shared. We have a new administration. A lot of things have happened. Trump has signed many executive orders that will have a significant impact upon our economy, both in the short and even longer term going forward. We're going to try to unwrap some of these because many of the questions I get today from people are, there's a lot of change. What is happening? How's it going to affect me, my money, the economy, and how do we react? Now, I'll say, first of all, I watched the inauguration address and various other times that Trump has spoke, including his speech to the World Economic Forum. It is a shocking and startling difference in demeanor and the message that he's sharing to everyone, regardless of the audience. It's hard in many ways not to get very enthusiastic about the future. As Trump repeatedly states, this is the beginning of a golden era for America. I am optimistic. I am encouraged too. Yet at the same time, I do understand there are some challenges we have as a country. Some of those will be resolved fairly quickly. Others are going to take more time. So please understand the things I'm sharing I'm not raining on the parade of optimism. I'm just trying to strike a somewhat reasonable balance using some common sense, history, what's going on. I'll use a quick example. I was young at the time, yet I do remember the transition from Carter to Reagan. The economy at that time was struggling in a very big way. Inflation was out of control. Interest rates were double digit. The Federal Reserve rate was at 20%. Mortgages were at 18% plus. It was a tough time for our country economically. The Reagan administration came in, enacted a number of changes, and over the next couple of years made a significant turnaround. And the 1980s were generally remembered as strong economic times for our country. But what I want you to remember is it literally took a couple of years for the economy, the interest rates to come back down to more reasonable levels, and the economy to start really getting going. And I believe today we're in much of that same type of situation. Again, as I stated, some of the problems our country has, for example, illegal immigration, stopping the invasion of illegals is an easy thing to fix, and it pretty much was fixed day one. Deporting many of these people will be an ongoing process, but should be able to be accomplished fairly rapidly. I was happy to see that a 90-day hold was placed on all foreign aid until some of our people in need are taken care of, particularly places like North Carolina and Los Angeles, due to some disaster situations. Things like Trump demanding that NATO countries provide 5% of GDP towards NATO is a very welcome move. If you look at the financial situation of NATO, the United States was paying a far higher percentage, both dollar wise and percentage wise, than most other countries. Very few were paying the 2% that was required. Many were paying far less, including economic powerhouses like Germany. One thing you need to understand is if you as a country do not have much in the way of defense spending, that does allow you to spend money on other things like health care. Frankly, the United States was footing the bill for most of Europe's free health care situation. Americans were paying for Europeans' health care. There's nothing fair or right about that. I was glad to see many of these things being addressed. The return to work of federal employees, executive order that Trump signed, very much in favor of that because there is a lot of fraud and abuse occurring. And in fact, the first day back, over half of the federal employees did not return to work. Now, no call, no show is a valid legal reason for being terminated from a job. Anyone listening who has ever had a job understands this. Unfortunately, there's many federal employees that currently do not believe they're subject to their rules. They believe their union rules or whatever supersede that. It remains to be seen whether they are correct. I would just refer you to the air traffic controller strike, the first year of Reagan's term. It was illegal for federal employees to strike or not show up to work then. It still is illegal to do so now. The laws have not changed on that. It will be interesting to see the fallout or the results of this. Trump has repeatedly stated, as has Elon Musk with Doge, that they want to reduce the federal employee workforce. That would be a great place to cut back waste, fraud, excess spending. One of the first things a company that's in financial trouble does to turn around typically is to reduce staff, reduce employees. That's a natural part of the process and something that is definitely overdue with the federal government. In my opinion, and many other legal experts, this executive order that Trump has signed requiring federal employees return to work full time, it is a lawful order. He is the chief executive. He's the CEO of the executive branch. Ultimately, they work for him, and he represents the American people, of course. It will be interesting to see how this plays out, but that certainly can be a very great cost savings for the federal government by reducing the federal workforce by a substantial amount. Short term could cause some economic impact, could increase the unemployment rates for a while, things like that. But the longer term benefits, in my opinion, far outweigh the short term pain. And I guess that's what I'm trying to point out here is I believe in many ways we're going to see some longer term benefits or medium term. There may be some short term pain in the transition or in the process of that, but it'll benefit our country economically for the most part in a significant way. Increasing energy production will certainly help reduce the costs of goods and services, particularly items that are purchased by consumers. Energy is one of the two largest contributors to inflation. The other is excess government spending. If the Trump administration is successfully able to tackle both of those challenges, we could see inflation dissipate or reduce back to more normal levels. The threat of tariffs currently has the bond market concerned because it is a fact that if tariffs are imposed upon products that are imported into the United States, it could increase the price of those products. As Trump has repeatedly stated and has been pushing for, is for these companies to produce more in the United States. Again, that's a transition. I believe a longer term good transition. An economy is not strong and diverse if it doesn't manufacture or produce much of the goods and services that its citizenship uses, especially a large country like the United States, has the resources, has the manpower, has the capability of producing much of what we need or want as consumers. This is a long term, positive, shorter term transition that could be somewhat painful. It's kind of like ripping the band aid off. But these problems haven't accumulated or occurred overnight. These are things that have built up over decades and need to be addressed and need to be reversed. As a result, I'm going to encourage you to be optimistic, as I am. I'm very optimistic about the future of the United States, medium and long term. I'm over the next 2 to 4 years plus. But there will likely be some short-term volatility, some short-term pain. To ignore that is foolish. Ignore at your own peril. Therefore, assets that are subject to market risk could likely have a negative impact in the shorter term, which I would define as the next year or two. I would proceed with caution, recommend reducing your downside risk until our economy and the situation and the changes have had their chance to take effect and let the dust settle, so to speak. Today, we're going to discuss a lot about what I believe is the number one risk to the stock market at this current period of time. And that risk is the bond market. The bond market is far larger than the stock market. Many people are unaware of that fact. Higher bond interest rates or yields are a very significant and strong threat to continuing increases in the stock market. I'm going to encourage you to stay tuned because I'm going to share some of the reasons why. And I think you'll find this very interesting. In fact, in the workshop I did this past week, the Master Your Money event I did with John Burley, this was some of the favorite information that the attendees thought was the most beneficial. So I'm going to share that here in the next segment. So I encourage you to stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. As I was stating in the first segment, it's hard not to get enthused and excited and optimistic about many of the changes that are rapidly occurring from many of the executive orders and actions that the Trump administration are putting into effect. There are a number of Democrats or people that you would not necessarily consider Trump supporters who have already come out and stated that many of these changes are transformative and will have a significant positive impact on America, our society, our economy. It's an exciting time for the United States, regardless of where you stand on the political spectrum. But at the same time, there's going to be some growing pains, some challenges, some issues that we'll need to address or deal with throughout the process of changing direction. Volatility is likely to be part of that economically. And here's a key point I saw that I thought was very interesting. There was a study or poll, I guess, done recently with the rich and famous stating they don't fear a stock market bubble. Now, this came from the World Economic Forum in Davos that happened recently. And they were asking, these are many of the world leaders in business, politics, etc. And they listed what they considered some of the greatest challenges in the world over the next year. And an economic or stock market correction was well down the list. It came in, for most of those people, it was in the teens. As this article stated, the rich and famous don't fear a stock market bubble, but this is why you should. Well, they've done this same kind of study at the World Economic Forum, and although many of the people attending are some of the most influential people in the world, some of the wealthiest folks in the world, it doesn't mean they're immune from human emotions. There's something called recency bias. This is something that's often discussed with investors in Wall Street. It's interesting that right after the Great Recession of 08, 09, a stock market correction was one of the top concerns of the attendees of the World Economic Forum. Yet the market at that point had already dropped approximately 50%, if you measure, for example, the S&P 500. The reality was at that point, the risk of further stock market losses were far less, statistically speaking, than it was a year or so prior, because the drops had already occurred. And in fact, through the hindsight of history, the market did start to recover at about that point and continued to do so for roughly the next 7 years to get back to where it was. But because the crisis, the economic crisis, had occurred so recently, it was on the top of everybody's mind. The problem we have now is we've had such a long run up, one of the longest in stock market history, one of the greatest increases in the history of the stock market. The last 2 years have been particularly strong, especially in the tech sector. Human beings have a short memory. We have something called recency bias. It's been a while since we've had a real correction. People tend to forget, tend to lose sight of the risk that they're really taking. And that's why this article from MarketWatch was pointing out why, although the rich and famous may not fear a stock market correction, you probably should. Because, by the way, that's when it tends to happen, does it? When it happens when we least expect it, oftentimes. And another point, I've brought this one up a number of times, but it's known as the Buffett indicator. It is a measure of the total value of the U.S. stock market to GDP, or gross domestic product. Generally speaking, the average is about 120. That's the 20-year average. In other words, the value of the stock market, the entire stock market, is about 120% of GDP. After the 08, 09 Great Recession, it got down to as low as about 50%, or half the value of U.S. GDP. The previous high was about 140%. That was the dot-com bubble that later burst, and we saw approximately 45% drop in the overall stock market, S&P 500, etc. Today, the Buffett indicator is at 207%. You heard me correctly. It is at a level that has never been seen before. Warren Buffett himself has often referred to this as one of his favorite indicators in terms of the value of stocks. In fact, as recently as 2022, the Buffett indicator was below 150%. It has increased to over 200% in just the past 2 years. This is not the signs of a healthy market. Why bring this up? And I had a discussion with somebody today, and I have this discussion on nearly a daily basis with people. I don't like to be a negative, rain on your parade type of person. But when nearly every single indicator, measuring stick you can use, is showing that the U.S. stock market is at extremely high or high overpriced values, you just can't ignore the facts. Yet what I find is most people I talk to are either misinformed or, in most cases, unaware of really what's going on and what levels of risk they are now potentially incurring. I had a gentleman I met with today who was not excited about a 6% guaranteed tax-free return or an 8% guaranteed first year with an annuity because, as he put it, I can make a lot more money in the stock market. And my response was, certainly in the last 2 years, I'm sure you did. And in fact, he did. Frankly, he invested heavily in the tech sector and had won that bet. As I put it to him, you grabbed the tiger by the tail. You got a tremendous return. I saw the same thing back in the dot-com bubble. We saw the same thing prior to the 08-09 recession. This is nothing new. In fact, if you want to go back far enough in history, do you know that in the 1500s, there was a period of time some tulip bulbs sold for more than the value of a house? In other words, speculative bubbles are nothing new. This is basic human emotion, fear and greed. I shared some of these things with him, and I could tell he was somewhat dubious about what was going to happen in the future. I stated, again, no argument, you won the game in the past couple of years. No question. The stock market since 2010 has been overall on a tear, with rare exception. It's been one of the greatest increases in the history of the stock market, with the past 2 years seeing over 20% returns in the S&P 500. That is not common. That is very rare. And in most cases, nearly every case, the next decade following, roughly, is a far less prosperous period for the markets. History shows that, and then I also pointed out that analysts from multiple sources, including BlackRock, JP Morgan, Vanguard, Goldman Sachs, others, have all come out with predictions of the S&P 500 averaging 3 to 5% over the next decade. That's their projections, not mine. He was rather dubious about that. Again, recency bias. He has gotten so used to a situation where he's seeing strong double-digit returns for the past years, he's fairly convinced it's going to happen again. And my point to him is that that has only occurred ever once, where you had more than 2 years back-to-back 20% returns in the S&P 500. That happened to be prior to the dot-com bubble. We all know what happened after that. 45% drop in the S&P 500. My point to him was quite simple. I'm not saying you necessarily need to pull entirely out of the market, but to cash in some of your winnings, to reduce your risk, to pull some off the table, makes prudent sense. That started to register with him, and we discussed further, recognizing the fact that he was really becoming euphoric even about his expectations about his returns. Again, I'm not a person to rain on somebody's parade, but at the same time, one of the statements I make with people when I meet with them is, do you want me to tell you what you want to hear or what you need to hear? I'm not the only one saying this. David Einhorn, he happens to be with Greenlight Capital. He made a statement recently stating we have reached the fart coin stage of the market cycle. It's kind of a funny way to put it, but as he put it, other than trading and speculation, these things serve no other obvious purpose and fulfills no need that's not served elsewhere. If it wasn't so ludicrous, and if I had not seen it before, I would think this was fake. But there actually recently was something that was issued, a crypto token called Fartcoin. I'm not kidding, folks. That coin grew to upwards of $2 billion of market value, which surpasses many U.S. listed companies. There's nothing, it's absolutely ludicrous. It's nothing but speculation, euphoria, and we've seen this all before. I've been on this rodeo before. We've seen these kinds of things before. It's human nature. Don't allow your emotions to overwhelm and cloud your thinking. If you're still at a point where a substantial portion of your portfolio is subject to downside market risk, I can't encourage you strongly enough to consider reducing some of that risk, pulling some of those winnings off the table, and protecting your downside. Could the market continue to go up from here? Absolutely. No argument. Could it crash and correct from here? Again, absolutely. Positively could do either or both. From a statistical standpoint, when you're at the extreme high ends What is the likelihood? Where's the greatest risk? To the upside or to the downside? And there's no argument from any logically thinking person that can argue that the risk to the downside is far greater now at extreme high levels than it is at any other point in time. Your personal bank, fixed asset investments, we're in the golden era. It's the best time in over 40 years. If you haven't seriously considered it recently, or if you haven't looked into these recently, there's great tools available now that you can use to reduce some of your market risk, and it just makes prudent sense. Stay tuned in the next segment. I've got a number of other things I want to share with you that I did not get to regarding the bond market, which again is likely the greatest risk to the continuation of the bull market in the stock market. So stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. To give you one more idea of what stage we're in the market, we're in what is considered late cycle of a bull market. I would even venture to say potentially extremely late stage. Here's another example of that. Nancy Pelosi recently put $100,000 into a stock. The ticker symbol is $TEM. The next day, it went up 52%. These are speculative plays. She obviously had some inside information that something was going to happen. And these are the type of things you see commonly at the late stage or end stage of a bull or speculative market. It's just another red flag. Ignore these warnings to your peril. Now, the number one risk to a continuation of the bull market happens to be the bond market. We're going to discuss this a little bit because a lot of people do not realize this, even seasoned investors. One of the number one reasons why the bond market is surging, yields are surging, which are interest rates that bonds pay. And again, for those who are not familiar, a bond is a financial tool that the federal government or companies will sell. And in many ways, it's like a CD. They will sell a bond for a certain period of time and pay a certain interest rate. Typically, a longer period bond will pay a higher interest rate, much like a CD. A shorter term bond will pay a lower interest rate. The only other difference really about bonds is that they can be traded. Bonds are bought and sold. CDs typically are not. I'm going to share the issue, and then I'm going to clear up some common misconceptions about bonds. First thing I'm going to say is this. The bond market is far larger than the stock market, than the U.S. stock market. Many fold times larger. Many people are unaware of this fact. Wall Street often refers to the bond market as the smart money and the stock market as the dumb money. I'm not saying that. That's them. Many of the large institutional investors invest far more of their money in the bond markets. Yet there's some that will play back and forth depending on what's going on. When you look at large institutional investors like pension funds, insurance companies, banks, many of those are focused primarily on cash flow. A pension fund, for example, has pension obligations. If they can receive a decent rate of return safely, even guaranteed for the most part, they're more than happy to invest their money there to meet their pension obligations. They want cash flow. Many of these institutions are multi-billion, even trillion-dollar entities and have the capability of moving markets. Good rule of thumb is when the 10-year Treasury hits 5%, many of these large institutional investors looking for cash flow will move much, if not all of their monies, or the vast majority of their monies, into the bond markets to secure that cash flow. Recently, the 10-year Treasury has been trading at about 4.75. It even touched 4.8. Keep a close eye on this. It's not a hard and fast rule. Clearly, the higher the 10-year Treasury goes, the more of the institutional big money flows from the stock markets to the bond market. When the big buyers move out of the way, prices tend to go down. Generally speaking, at a 10-year Treasury rate of 5%, in nearly every occurrence, the stock market has declined. There's a very high likelihood of the 10-year Treasury hitting the 5% target and even higher in the near future, regardless of what the current administration does. This is why. We all know the federal government has been spending more than it receives for decades now. It's been on an increasing trajectory. Last year, the federal government spent about $1.9 trillion more than it received. They print the difference. What a lot of people are unaware of, though, is that the federal government cannot just print money. They actually have to sell a bond to offset that currency that they printed. Therefore, they're required to sell with record deficit spending or record printing of the money. They have record offerings or sales of bonds. When you have a record amount of bonds being sold, you have to increase the yield or the interest you're going to pay to those bond buyers to entice them to buy these bonds. That is what is happening, and a lot of what's driving the bond markets up. Now, in addition to the deficit spending, let's assume that Elon Musk and Doge and the Trump administration are able to accomplish Elon's most optimistic goal, he stated this himself, of reducing federal spending by $2 trillion annually. Again, as I stated earlier, the federal government is currently spending about $2 trillion more than it receives. If Elon is successful and accomplishes this goal, that means the federal government will start to live within its means for the first time in literally decades. This would be a tremendous accomplishment. Anyone who believes the federal government should spend more than it receives does not understand basic budgets and finances. We all know that you as an individual or a company cannot spend more than it receives indefinitely. You can do so for a short period of time, incur debt to make up the difference, but eventually that catches up to you. The federal government has more leeway on that because they can print money and sell those bonds, but even they have limitations on how far that can go. We are approaching many of those limitations, according to many experts and economists. Here's the problem. Even if the federal government reduces spending, waste, whatnot, fraud, and starts to live within its means, there's still $36 trillion of outstanding debt. The government sells bonds anywhere from 4 weeks to 30 years and all types of time frames in between. Each year, a certain amount of those bonds mature or expire. The government at this point does not spend down the debt. It resells the bonds at the new current interest rate, which is far higher today than it was even a couple of years ago. Let me give you an example. About 2 years ago, the federal government was selling 2-year bonds at about 1% or so. Today, that same 2-year bond, they sell at 4% plus. That is a significant increase in interest that the federal government has to pay to get bond buyers to purchase those bonds. That is what's driving interest costs on the debt. It's a combination of the total amount of debt and the higher interest costs, which I project, as many others do, is not going down anytime soon. Here's why. In 2024, about $3 trillion of bonds matured or expired, and the federal government had to resell those. This was on existing previous debt. The level of debt bonds that are set to mature in 2025 is approximately $7 trillion. The $3 trillion from last year was an all-time record. It's going to be more than double this year. The federal government, even if it does not spend a dime more than it receives, which so far is not happening, it's still spending far more than it receives. But even if that gets fixed, they're still going to have to sell about $7 trillion of bonds in 2025. That will drive bond yields higher, interest that they're going to have to pay bond buyers higher, because you're talking about a literal truckload, a tsunami of debt, of bonds that they're going to have to sell. The bond buyers know this. They're not stupid. With all this supply, they're going to demand, and already are demanding, higher interest rates, higher yields. This high level of bonds maturing, multi-trillions of dollars of debt, continues through 2030 for the next 5 years, folks. Even if the government gets back into living within its means, not spending more than it receives, it still will be forced to sell trillions of dollars of debt every year for the next 5 years. This will drive bond yields up, drive interest rates up. As I stated in the workshop I did last week, if you're looking for lower mortgage interest rates or borrowing costs on nearly everything, you will be sorely disappointed. The only way to solve this problem will be the federal government will have to start paying down on that debt. In other words, apply revenues, not printing more money, but apply revenues to not resell those bonds and pay them off. At this point in time, it's highly unlikely that will occur, certainly in the next few years. Many of the transformational changes, as I stated earlier in this show, that the Trump administration is enacting will likely, in the longer run, offset much of this. But this will take some time. By the way, the level of bond selling, or bonds that will mature over the next 5 years, is multi-trillions of dollars each year, and doesn't actually dissipate until 2035. So the next 10 years will still be a significant level of bonds maturing on the existing debt that the government will be selling, which will, in general, push bond yields, bond interest rates higher. This is why Vanguard analysts and many others have come out stating that bond rates will stay strong for the next decade. This will have a significant negative impact on the stock market, as strong bond yields will cause many institutional investors to invest much, if not the vast majority, of their portfolio into bonds to get cash flow. If you're not paying attention to this, or you're not aware, this will affect you in a negative way in many of your investments. If you are aware that this is the golden age of fixed assets, that you can put money into your personal bank plan to grow your money safely, insured, guaranteed, tax-free, and highly liquid. You can put your money into an annuity and get returns that have not been seen in 42 years. We have companies are paying upwards of 8% guaranteed the first year. Other companies are paying up to 21% bonus, signing bonus, and strong returns, minimum guarantees going forward. Significant. In fact, many times higher than the projections of the S&P 500 by these analysts for the next decade. You can set up a guaranteed lifetime income account and get as much as a 30% bonus, signing bonus, day one, 8% increase each year you defer that income, which means if you defer the income by 1 year, you'll increase your guaranteed lifetime income by 40%. If you want a pension, or you want to increase your pension, there's never been a better time. You can increase your pension payout by 40% in 1 year. If you want to defer longer, I have companies that will increase the pension payout guaranteed lifetime income to you by 14% annually. Each year you defer, your guaranteed lifetime income, or pension check, if you will increase by 14%. I have never seen anything like this in my career. This has not existed in the past 42 years. This truly is the golden era of fixed assets. And it's becoming increasingly likely, due to the bond markets and all the things I just shared, that the returns of many of these assets will outperform the S&P 500 over the next decade. That's not me projecting that. That's Goldman Sachs, BlackRock, JP Morgan, Vanguard analysts, and others. If you want more information on this, contact me at yourpersonalbank.com. Stay tuned to the last segment. I got some more interesting information. Some of it I think will be kind of fun. I encourage you to stay tuned. Don't miss it.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. In the past segment, I shared information about why the bond market is surging, likely to continue for the next 5 to 10 years, the impact of government debt and having to sell bonds that mature. I shared this in a workshop I did recently with John Burley, Master Your Money. This was one of the most well-received portion of the workshop that I did. The people that attended absolutely loved it. I got tremendous, overwhelming positive response. And this is information I have not heard literally just about anywhere else, yet it's a fact. You need to be aware of it. You need to understand it to make better financial investing decisions going forward. If you missed it, I'm going to strongly encourage you to go to yourpersonalbank.com or the Your Personal Bank app. You can listen to this or any previously recorded show anytime you want. Each will have its own topic. You can check out what interests you. Again, miss that information, tremendous, valuable, and timely. Because of what I shared in the last segment about what's going on with the bond market, this is why we're seeing article after article stating, it's time to buy bonds. It's time to buy bonds. Here's why, etc. Now, we're also at the same time, this is where much of the confusion comes in. We see articles that'll say bonds have had their worst decade in 90 years. But why now could be the time to buy? See, the confusion comes about is the article referring to a bond trader or a bond investor? There is a difference, a massive difference. As I stated earlier, bonds are an investment where you get paid a guaranteed interest rate for a certain period of time. The value of bonds can vary, but the key is you need to understand what is the purpose of purchasing that bond for you. Are you buying it for cash flow, or are you buying it for future value, much like a stock accumulation? You can do both. This may help clarify. For example, about 2 years ago, if you bought a 30-year treasury, the government was paying about 2%. In other words, you would get paid about 2% return on that bond for the next 30 years. Obviously, that's not a very good interest rate. Historically, that's very much on the low end. Today, that same bond, that same 30-year bond from the government, pays about 5%. So for many investors, institutional investors and others who purchase these bonds at 2%, 30-year bond, for example, now they pay 5%. Obviously, a 5% bond is far more valuable than a bond that pays 2%. Therefore, the bonds that were purchased a couple years ago or so, over much of the past decade, they were paying very low interest rates, are today worth far less than the current ones that are being sold. So again, what's your purpose? Are you buying the bond to hold it and receive income? If that's the answer, then this is the greatest time in 42 years to buy bonds. You get a higher return. That's tremendous. That's awesome. I would venture to say if you purchased an annuity or a high cash value dividend paying policy, you'll get the bond rates plus, because profits of the insurance companies, that's what dividends are, they add to whatever the bonds are that they're investing. That's why you can get 6 to 8% returns today. If you're a bond trader, in other words, you purchase this bond to later sell it at some future, like a bond fund, etc. The bonds you bought over the past decade, for the most part, are worth far less than the new ones today. You're stuck with these undervalued bonds that are paying below market interest rates. They're not very valuable. And again, as they stated, it is literally the worst time in 90 years. That's the amount of value they lost. It's even worse than the 1970s, folks. Nobody alive has ever seen this. So when you see an article where they said, oh, bonds are terrible, or it's the worst time, blah, 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 they're talking about bond traders, bond funds, these funds that purchase, buy, and sell bonds. Yeah, they're taking a bath. They're getting hurt. Also, who it's hurting are banks. Banks are required to invest a certain portion of their assets in safe investments. Many of them purchase bonds. And to their detriment, the bonds they bought, again, over the past decade, that they are still holding are worth far less on their balance sheet, and it's hurting their requirements, or what's called unrealized losses, for banks. Their value of their balance sheet is less. The amount of money that they can loan, the profits that they can make, are affected in a negative way. Again, worst time in over 90 years. So we have many banks right now that are struggling. Their balance sheet is struggling because they're required to balance their books and have certain amount of percentage of reserves and whatnot, and their value of their overall portfolio has declined dramatically because of the value of their bonds. Yes, they're hurting, but they're also hurting because they do something many of them do, fractional reserve lending, where they lend out far more, many fold times, often 8 to 10 times more than they have in deposits. So because they're leveraging like that, everything is accelerated. In other words, if you leverage 10 times and you have a 1% loss, you have a 10% loss. It's leveraged tenfold, right? This is why banks are struggling, yet insurance companies are not. They don't leverage. Insurance companies are looking at some of the greatest financials, certainly in the past 42 plus years. The reason is simple. The bonds that they're purchasing today are paying them a much higher interest rate. As I stated earlier, a bond purchased 2 or 3 years ago was paying about 2%. Today it's paying around 5%. That's a 250% increase in return, 2.5 times, 2.5 fold. That's a tremendous increase in returns. The bonds that they're purchasing now, each bond they're purchasing every week, are earning them more and increasing profits. This is expected to continue for the next 5 to 10 years. This will be a cumulative effect over time. You're going to see a situation where dividends likely will increase to record levels, certainly levels we have not seen since the 1970s. By the way, dividends back in those days, 12, 14, 16% was not uncommon. Will we see those kind of levels again? That I'm not sure of. But we will see historical averages are in the 7 to 8% range. We will be approaching those levels in the relatively near future and likely bypass those levels with dividend paying policies or with annuities. This is truly the golden age of fixed assets. Don't miss out on this opportunity. Much like we had a generational opportunity over much of the past decade. With mortgages, for example, many people were able to secure 3% or even below 30-year fixed mortgages. That was a generational opportunity. If you did not take advantage of that, you have missed out. It's too late. That bus has left the station. The low interest rate environment, quantitative easing, easy monetary policy of the Federal Reserve for the foreseeable future is behind us. It was a great time for business, for taking on risk, for growing your business, investing in the stock market, and real estate markets for that matter, and seeing tremendous growth, even speculative growth. We're in a different economy. We're in a different situation. Yes, there's reason for optimism for the future. Don't get me wrong. But those types of opportunities have left. We are in a different economy today. realistically unlikely for that type of economy to return anytime in the foreseeable future. You're not going to see a 30-year fixed mortgage at 3%, very likely for the rest of your life, because it never happened before like we saw then. That was the lowest interest rate environment for the longest period of time in the history of the United States. That drove asset prices up. In addition, we had a tremendous record-setting helicoptering into the economy of printed money, which drove asset prices through the roof, or also known as inflation, because it caused the prices of everyday items to go up as well. Our federal government cannot afford that kind of printing anymore. In fact, it needs to do the opposite. The spending spree is coming to an end. Now, whether the politicians manage to fix it, which I am very dubious about, the market forces, the bond buyers eventually say no more. They balk, which would then force the U.S. into austerity measures or force them to live within their means and start to pay down some of that debt. That is the most likely scenario, what is coming down the pike. The economic scenario that we're in has changed. I can't stress this strongly enough. Whatever you were doing before that worked over the past decade is highly unlikely to work in the future, over the next decade. In fact, what was out of favor the past decade is what's likely in favor this decade. There's no secret. The dividend paying policies were not paying that great of returns. They were still a solid investment. There was safety, there was tax benefits, but the returns weren't all that spectacular comparing that to the stock market. You could say the same thing about annuities, guaranteed lifetime income. All of that has completely flipped on a dime. We are now seeing 40-plus year record returns on those types of things, and nothing but likely increasing in the future. Again, everything that worked before, you need to be skeptical of, and everything that was somewhat out of favor before, you need to consider and probably embrace. Economies change, economic situations change. You have to evolve. You either evolve or die, like the dinosaurs. They were not able to evolve. They suffered. Don't be a dinosaur. Don't allow the ideas and notions of what was out of favor before cause you to not consider making a change now. It will likely be to your detriment going forward. Uncertainty, volatility are the most likely scenarios of what we're going to be facing going future. I'm not trying to be negative. I'm trying to use common sense, history, red flags, indicators, everything that tells us and gives us an idea of what's going on. Protect yourself. You're not going to regret that. Protecting your downside, at least on a portion of your portfolio. And personal bank policy, and it's highly liquid, when the inevitable correction does occur, and it will occur, folks. I can't tell you when, how much, or how long. No one can. But will there be a correction? Certainly. When it does occur, you will then be in a position to take advantage of it. As I shared this last thought with somebody today, much like a roller coaster, most people in amusement park get in line and get on the roller coaster, and they ride it up, which is fun, and they ride it down, which is scary. You don't have to ride the roller coaster when it comes to your money. There's other safer options. As always, stay tuned to the Your Personal Bank show next week. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank show for more information. Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ferenc at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.